For months, people were concerned about what tariffs can do to the stock market and the economy. But we are here now. So what exactly are tariffs? What can they do to the stock market? What have they done to the stock market already? What is happening right now? And what do we need to do as investors? Oh, let's go ahead and break it down. This is a developing story. What do I mean by that? I'm recording this on a Monday, which is we're gonna see, okay? But I'm recording this on the Monday morning. There were tariffs on Canada, China, and Mexico. Before 5 o'clock, there was a 30-day pause on those same tariffs on Mexico and Canada. This is a developing story. However, this is how we're going to break this video down, all right? We're gonna start off explaining what tariffs are, how they work, why tariffs are supposed to be good, and then talk about the investing angle, what you need to know as an investor and what you may want to consider doing as an investor. And then we're also going to throw in there in the middle where we are right now with the tariffs. Now, I want to make these conversational. I want to try and anticipate your questions, so you do want to stay all the way through the end because, again, just try to make this as conversation as possible. If you do have any questions, ask them in the comments. And as this does develop, I will be in the comments as well. Members will likely see this at some point, either early Tuesday morning or at some point Monday night. Again, it is developing. Things are likely going to happen throughout this entire saga. All right, so first, what is a tariff? A tariff, at the end of the day, in its most simple terms, is a tax. It is a tax. Now, the question is, who is it a tax on? Directly, it is a tax on the importer. Who is the importer? The importer is the company. All right, let's take Walmart or Target for example. What is the job of Walmart and Target? It's to sell stuff. They are a retailer. Where do they get stuff to sell, right? They get it from companies. For example, if it's an American company, they go buy a whole bunch of stuff and they sell it. If they buy things from overseas, they are what? Importing those things. They're bringing it over from ships. They're getting it from trucks, perhaps from Mexico, from China in the case of a ship or a plane, or Canada or whatever, right? And they're bringing those things over and they're selling it to you. That's how they make money. Now, a tariff says that if you are importing it from a foreign country and we slap a tariff on it, you're going to pay 10, 15, 25% more for that item. So Walmart now, let's say in the case of avocados that are coming from Mexico, you said the jingle, didn't you? You did. All right. So if you do that, you now have to pay 25% more. Walmart, thanks. Okay. The U.S. Treasury gets that money. Now, what does Walmart do? Walmart then takes that 25% and passes it off to you, the consumer. So it is an indirect tax to you. You will pay 25% more if you decide to continue to buy avocados. So at the end of the day, it is an indirect tax on you, the consumer, a direct tax on the importer. That is how a tariff works. The person who is selling the avocados, they're not paying none of that. They just don't, okay? So that is how it works, all right? Now, why are tariffs effective, or why are they good, or why are they at least perceived to be a good thing? Well, depends on when you are looking at this. Now, in the year 2025, and really any year past, 1910-ish, is not as good as what people used to see tariffs as. Now, a tariff is really seen as a protectionary measure to protect American industry or protect your home turf, right? To protect American jobs, to protect whatever your home goods are. The problem, though, is in a world that we live in today where travel is a lot easier, you can send things global, and we have multinational companies today than what we did 100 years ago. Sometimes it makes more sense to have things overseas, and we also don't make all the things that we need to make in one country. For example, regardless of how many tariffs you have, regardless of what you want to make in a perfect society, we don't have the climate to make avocados. We don't have the climate to make bananas. And we don't have the labor force or the cost to make certain items cheaply. For example, if you want to make some of the items that they make in China, we are all going to have to pay 9 times more for those items. And you don't want to do that. We've all agreed, right? Whether you have explicitly done so or not explicitly done so, the washing machines that we buy, the cell phones that we buy, they're assembled in other places for much cheaper. If you don't want to pay $1,000 for an iPhone, to have that assembled here in the US, that same $1,000 iPhone could cost you $5,000, $6,000, or $7,000 to have someone do it here. Now, it sounds great to have it American made, and I guess I would also prefer that. But do I really want to pay $7,000 for the exact same iPhone that I have right now? Probably not, right? So there is a benefit and a trade-off there. So it's not necessarily, what we think is going to happen. So the reason as to why people think it is good is because you theoretically keep jobs here and you protect the manufacturers and the things that are here. There's another thing, though, that happens in real life. You also have what are called retaliation, right, or retaliatory tariffs. And we actually talked about this 6 months ago, okay? Back in July, which I guess was 6 months ago now, but back in July, we talked about the possibility of this occurring. And this did happen about 48 hours ago before we had the pause. For those who missed it, this morning, both Mexico and Canada agreed to pause tariffs and retaliation for about 30 days. So we'll see where this goes in the next 24 hours. We'll see what happens there. But in either case, countries that we decide that we want to slap a tariff on, they can also slap a tariff back on us. And that makes our goods more expensive. What does that do for us? Well, we also want to sell things, right? It's called trade for a reason. It's not a one-way street. For example, we export a lot of things. Soybeans, agriculture is one of the biggest things that we kind of push overseas because we make way more food than what we actually eat. And we need to sell those things. And there's a reason why. For example, once we ship our things overseas and they start to slap a tariff on us and we cannot sell as many because they'll say, all right, I don't want to pay 25% more on US beef or US soybeans or whatever. I'm going to buy less. They start buying less. What does that do here? US companies are going to see less sales. We start to see less sales. We start to see a lower workforce, right? And people start to get laid off. If that happens across a broad economy, you are going to see a recession. It's not necessarily something that you want to see. Now, the question is, how wide are the tariffs? Are these tariffs going to stay? And how big are the retaliations going to be? But we did see this back in the 2016 trade war between the US and China, where some farmers were absolutely hurt and the US government did have to prop those farmers up because people were not buying their goods because of the retaliation tariffs in China. So this is something that did occur. The thing was, it was just a very narrow tariff in just parts of the agriculture business. It wasn't something that was widespread. The question is, how wide are these tariffs going to be? How long are they going to last? And in which countries are they going to impact? So that is how it does play out in real life. So now you know how it works. Now you know how it kind of plays out in real life and why some people think that they are good. How they play out, whether they are truly good, we are going to find out here pretty soon. Now, how do they play into the stock market? Now, as of Monday, the stock market did drop, or at least the NASDAQ tech stocks did drop about 1%. Generally speaking, it depends on how broad these are. But no, these aren't typically good for the stock market. And the reason is this. The stock market does not like things that are unpredictable. And here's an example of this. If I'm a business, right, and I am importing something from China, 2 days ago, roughly 2 days ago, I was importing something from China and it was, let's say, $100. And then there was a 10% tariff that made it 10% more expensive for me, and it is still more expensive for me. If I was importing something from Mexico, it was 10% more expensive for me 2 days ago, and now it's not because it's paused for 30 days. But now, if it's 2 months out and I'm making something now, because not every item I'm making is going to be created by then, how do I estimate what things are going to cost me in October? Because things that I create, maybe it's a car, right? You don't make cars instantly. How do I know how much things are going to cost and what I need to budget for things that are going to be created in the future. That is not good because I have to tell my investors what I'm expecting, what things are going to cost. I need to hire employees. I need to figure out what interest rates are. And all of these things are going to factor into the stock market and how investors are going to react and how we need to decide what we are and are not going to buy as investors. So the stock market is likely going to continue to be choppy until we know exactly what is going to be tariffed, how much these tariffs are going to be. Are these things going to be stable or are they going to continue to increase? Because again, imagine thinking and knowing, okay, look, it was going to be 10%, 25%, now it's nothing for at least 30 days. Is that going to get extended? Is it going to increase? Is this whole thing going to be ripped up to shreds in the next 12 hours? We don't know, and that is not a good thing for the stock market. We prefer, the investors in the stock market, we prefer predictability. So that is something that's not all that great, but there is something that investors should or at least consider doing as well. Now, one other thing that the stock market is going to pay attention to, and one other thing you at least want to consider, is put yourself in the shoes of a business owner, right? When it comes to trying to figure out what costs are and what to expect, right? Another option, right, is to either A, front load. You could have, because we all knew tariffs were coming at least since November, right? You could have front loaded and started importing a bunch of stuff, right, from November to now. Some companies have done that. The thing is, you can't front load stuff for 4 years. Okay, so that's one thing. Also, you can start to move your importing or your manufacturing from China to, let's say, Vietnam or somewhere else that is very cheap to manufacture. You could have done that, but it also costs a lot of money too. Some companies have already tried to do that and started to do that. That's something else. So people had talked about, well, it's going to bring jobs back to the U.S. because of these tariffs. Not necessarily, because companies can just sidestep and say, all right, you're going to tax things in Mexico. I'm just going to move to, I don't know, Guatemala. I'm just throwing a country out there. I'm going to move things to Vietnam. There are no tariffs there. I'm just going to step to the left instead of moving things back here because, again, labor laws and all the other things that we Americans do require and need and frankly should have, health insurance, all that type of stuff, it's going to make it more expensive. So companies aren't necessarily going to move it back here. It's going to move somewhere else, right? Indonesia and all these other places as opposed to moving back here. So just because you enact a tariff doesn't necessarily mean that all those jobs are going to come back. That's more of a fantasy than a reality. And again, it's going to take time if that was even the case because you have to build all those factories, move all that stuff back, and then all those companies going to be even profitable by doing so. And then what is that cost going to be? Go back to the iPhone example as well. Now, investors, what should we do in a time like this? Right now, at this moment in time, early February, relax. Okay, I know it's not easy to relax, but again, we just saw what happened with Nvidia. Nvidia took a double-digit loss. The very next day, it had a very big jump, and now it's kind of up in the air. We'll see what happens with all the stuff that's happening in the AI space, but given the chaos, it is usually best to stand still and continue buying, usually doing what is called dollar cost averaging. I think the strongest position for investors to be in is just a basic, boring index fund. We don't talk about it enough because I think that's the backbone of where most people should be. I do talk about that, but I don't emphasize it enough. It's very difficult, extremely difficult to just, guess with this level of chaos where you got a tariff in the morning, you don't have a tariff at the end, but it expires in 30 days. There is no skill in trying to stock pick in a time like this. I wouldn't necessarily recommend it. Just stick with an index fund in times like this. We will talk about, the best spaces and industries for high inflation, but nothing necessarily super tariff related. And we did talk about things that are, necessarily inflation and what's the word I'm looking for? Inflation and election proof, like something like a Netflix that should probably still do well. So those are things you can look forward to, but I would say the quote unquote as safe as you can get for the stock market, and the stock market can still fall, is an index fund, dollar cost average, and ignore the noise. This is still noise. It is only February. Things are going to get a little more interesting, but you should be in this for the long term. I've already seen people panic. Don't be doing all that. Okay, don't be doing all that. Okay, we've already talked about how the stock market falls at least 5%, 5 times a year on average. All right, so this is not a time to panic. Things are going to be rough. Expect that. We have talked about this since July of last year. So this isn't something that wasn't on the bingo card. It absolutely was. This was something we talked about in our 2025 workshop. So if you signed up for it, you already know what to do. This is not something that was unforeseen. Okay, this one was on the bingo card. So I would look at it like that. It was on the bingo card. You got some chips on the table. Do continue to stockpile cash. It was something was on the bingo card. So not something that should shake you completely, but do stay focused, stay out of the noise, continue investing in index funds, continue stocking your savings account as well. If you want more investing tips on how to stay calm in times like this, as well as other stock ideas that can help you out in a time like this, you want to check out this video right here.